You want to know how to combine trading indicators so that you can better time your entries and your exits and then ultimately get better trading results. So in this video, you will learn how to categorize the indicators by their purpose. So we're going to cover the market conditions, area of value, entry triggers, and trade management. We will also then talk about the best indicator combinations. So that's where you're going to know each of their purpose, where you're going to use like one indicator from each category, right? And not more than 3 indicators altogether. Let's take a look at this chart right over here. So tell me, what's wrong with this? I mean, for some of you who are looking at it, you could be thinking, there's nothing wrong with this. It looks good. So let's look at the signal of this chart. What is the market doing? The market is going up higher. I mean, I see what you're saying. So you are probably noticing that the indicators like the RSI, the CCR, the stochastic are all pointing upwards. And this suggests a bullish market trend. However, the problem with this chart is that these indicators, all these that you're seeing here, are correlated and they are all oscillators. So these indicators, right, they move in a similar manner, right? Because they are calculated and based on similar principles. So when one changes, the others tend to change too. So it's not necessarily because like there is a strong signal or the market will definitely go up. It's just how these indicators work together. Yeah. So when one indicator goes up, the other tends to go up too, right? When one goes down, the other usually goes down as well. So it's not because that hey, it is a strong signal, but because these indicators work in the same way. So their logic and the math behind it are the same. They move together. So many traders will then make a mistake by putting lots of indicators on their charts. They see that, they're all pointing in the same direction. And they think that, it's guaranteed a win when they all point in the same direction. But when the market goes like the other way, they lose money and then they wonder why. Just because all the indicators agree doesn't mean that it is a safe trade. Adding too many indicators doesn't help. It just like complicates things and doesn't improve your overall trading. So the question is now, how do I combine the trading indicators in a way that adds value to my trading and makes sense? And that is the question. So that is what we are going to cover. So the way that I do is by categorizing the indicators based on their purpose. Like while some people categorize their indicators based on their types, such as oscillators, volume, or trending indicators, I prefer to categorize them by their purpose. So to effectively combine them, you need to understand the math and the logic behind each indicator. So to simplify this process, I have grouped most indicators into one of 4 purposes. So most indicators will fall in one of these 4 categories. Ready? The first one is market condition. The next is the area of value, followed by the entry trigger and trade management. All right, let's talk more about it. So, market conditions. When looking at market conditions, you will want to determine whether the market is moving in a clear direction. Like whether is it moving clearly up or clearly down? Or is it just like bouncing around in the range? You also want to see if the prices are changing a lot. And that means like high volatility. Or are they staying like pretty steady, which is low volatility? I mean, if it's trending, you can just be bouncing a lot, right? Or you could just like going up, which is really steady. So there are a lot of tools to help with this. Let's keep it simple. I'm only using 2 tools: the moving average and ATR, the average true range. So I'm going to keep it simple to help explain the concept to you. For the moving average, look at this black line, which represents the 200 period moving average. So this line shows the average of the past prices, the past 200 bars. So for example, if prices have been going down, the 200 moving average calculates the average price over the last 200 period, and it shows it as a line on your chart. So if price has been falling, the moving average line will also point downwards. So you can then use this indicator to tell you whether the market is trending higher or lower, right? Based on where it is pointing. So one way to approach this is if the price is under the 200 moving average, you will want to consider the overall market is in a downtrend. So in such cases, you want to search for selling opportunities, like the one shown here. So generally speaking, if price stays below the 200 moving average, it indicates potential selling opportunities. On the other hand, if price consistently stays above the 200 moving average, you will want to look for buying opportunities. Let's take a look at the other indicator, the ATR, average true range. You can actually get the ATR out like this, right? Like this one here. So now let's look at the line at the bottom. The ATR indicator is not related to the stochastic and the RSI indicators. So that's because they serve different purposes. The ATR measures market volatility, while the two other oscillators oscillate between the 0 and the 100 and are used for different analysis. So you can see that this line here is dropping lower over time. So what is it telling you? It indicates that over time, from here right to here, the volatility in this market has decreased, right? This doesn't relate to the trend. It only measures volatility in the market, right? Take note of that. On the other hand, you can see that the volatility is decreasing here. You can notice that the range of this candle or bar is also getting smaller. Now, when you see that the volatility is high in this section, what does this indicate? It tells you that the range of the candles on the chart are large, right? They are wide, right? As you can see in this part over here. The range of these candles is large, indicating high volatility. So this is what the ATR does. It helps you to recognize market volatility, whether is it high or low. Then you will use this information to apply the appropriate trading strategy for these different market conditions. So let's talk about the concept of the area of value. So essentially what we are asking is, where might be the potential buying or selling pressure comes in? This is really important, right? So we got to determine this. In order to do so, we will use tools like the moving average or the stochastic indicator. Let's go in deeper. So for example, okay, so we're going to switch to the 50 moving average here, right? Because you can see that it represents a healthy trend, isn't it? So notice how the price tends to follow or respect the 50 moving average. Yeah, so it defines and it identifies an area of value at these lows. So this low, this one, and this. This 50 moving average is acting as an area of value where the potential buying pressure can come in. Does it make sense? Right? So similarly, right, you can also use tools like the stochastic whenever the price is below 20. This could also be considered as an area of value. Here, 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 and here. So these are two different indicators to help you identify area of values on the chart, right? Essentially, the concept of an area of value tells you where you should buy, right? It helps you understand why you should buy at certain lows, right? The area of value can assist you in identifying what is considered as a low in the market. So in a trending market, the tools used to identify the market condition helps determine whether you should be buying or selling. So on the other hand, the area of value indicates where you should buy or sell within that market. So while the market condition tools inform you of the overall direction, the area of value guides you on the precise points on where to enter or exit the trades. Moving on to entry trigger. So once you have identified your trading setup, you will now need a trigger to get you into a trade. So for many traders, this trigger could be, say, such as a hammer or a shooting star. However, indicators can also serve as entry triggers. So two common indicators used for this purpose are the RSI, which is the Relative Strength Index, and the Donchian Channel. Okay, so let's have a look, all right? For example, with the RSI, you might look to buy when the RSI crosses above the 30 in this case. When the RSI crosses above the 30, it can be seen as a buy signal on the RSI indicator, right? This serves as an entry trigger. So essentially, the RSI measures momentum in the market. So when the RSI crosses above the 30, it indicates bullish momentum entering the market, suggesting a potential opportunity to buy. Using indicators like the RSI as entry trigger, right? It provides you an objective way to enter a trade, right? This approach relies on, say, specific criteria such as the RSI crossing above a certain level, right? Making the entry process more systematic and less subjective, which is the key in trading, right? So similarly, right, the stochastic indicator can be used as an entry trigger when it crosses above the 20. So this serves as another objective method for entering trades based on specific criteria, adding to the systematic approach of trading. Now, the other entry trigger method is the Donchian Channel. So this indicator measures the highest high and the lowest low over a specified period, right? So typically the previous 20 days by default. So if you are interested in trading breakout trades, right, you can use the Donchian Channel. When price hits the upper blue line, right, this indicates that it has reached a 20-day high. And that could serve as an entry trigger for a trade. Finally, the last group of indicators assist you in managing your trades. So these indicators helps you. So what? Set your stop loss, your take profit, your trailing stop loss, and more. Right? So examples of such indicators includes the chandelier stop, pivot points, and the average true range, which is the ATR. Okay, so let's illustrate with pivot points, which is a commonly used tool, isn't it? Yeah. So when you activate pivot points, you will see several lines on your chart, right? You can disregard the earlier lines as they are no longer relevant, right? Pivot point work by taking the high and the low and the close price of the previous day and plotting the support and resistance level for the current day. So in fact, I can remove all the earlier lines to make it clearer, right? There you go. All the previous lines are now gone, right? So what you see are the current pivot points, right? For today's bar, right? Based on the prices of the previous day. So you might encounter resistance at this level, right? Here, here, and here, right? So similarly, you might find support at this level as well, here, here, and here. So this is how pivot point work. You can utilize them as target profits level, right? To help you exit your trades when you are uncertain about where to exit. Now, let me show you what the chandelier stop does. Okay, so you see this blue line and this pink line here, right? I'll change this to a 20 period ATR multiple of 3. right? So, I mean, earlier, right, we discussed the average true range, the ATR, which measures the market volatility, correct? So, setting a stop loss too tight could cause you to be stopped out due to, say, normal market volatility spikes. So, one approach to address this is to use the market volatility to trail your stop loss. The Chandler stop adds a multiple of the ATR value to your stop loss. Cool? Yeah. So, for example, right, as what you saw earlier, right, I use a multiple of 3 times the ATR, right? So from this point, from this low point, right, let's call it X. You add 3 times the ATR, right? So this gives you a value. So let's call it Y, right? So this Y value corresponds to the pink line that you see here, right? So from this high point to the low point is 3 times the ATR. So the Chandler stop provides you with a level to trail your stop loss, right? This allows you to ride the market trends effectively. Yeah. As the price continues to move lower, the pink line will also move lower accordingly. So this feature makes the Chandler stop a very useful tool for riding market trends effectively, right? That's how this indicator works. Now, what are the best combination of all these indicators? So how should you go about like combining them now? Here's the general guideline. Number 1, right? It is important to understand the purpose of the indicators. So what exactly are you aiming to accomplish with them? So are you, say, seeking to identify the trend, right? Then you use them as entry triggers. Or are you looking to pinpoint areas of value? So you got to clarify the purpose, right? That is extremely essential. Number 2, only pick one indicator from each category. As what you seen earlier, right? Many traders make the mistake of choosing like multiple indicators from the same category. I mean, this approach doesn't make sense. Therefore, just stick to selecting just one indicator from each category. So then, try to avoid having more than 3 indicators on your chart. I mean, in reality, you really don't need more than 3, right? So you just typically use like 1, for example, occasionally 2, or sometimes even none at all, depending on the situation. If you are a price action trader, 1 or 2 indicators would be enough to complement your price action trading analysis. So with that in mind, so let me show you some examples. So suppose now you are looking to capture a swing in a trending market. So in this case, you can use these 3 indicators, which is the moving average, the RSI, and the pivot point. So let me show you and I'll explain why. Okay, so we are talking about the RSI. So let me explain what I'm doing with these indicators. Right, so first, right, we are using the moving average to identify the trend for us in the S&P 500. So since price is above the 200 moving average, we can conclude that it is in an uptrend. Yeah. So therefore, we are looking for buying opportunities. Right? So next, we are using the RSI as an entry trigger to enter a trade. Maybe the entry trigger, right, could be when the RSI falls below the 30, right? So at this moment, the RSI is still not below the 30, right? So therefore, if it drops below the 30 and then it spikes up, we would consider buying. So this approach helps us to define both the area of value and the entry trigger, right? The area of value is when the RSI is below the 30 level. The entry trigger is when the RSI crosses back above the 30 level. Get it? Right, so now, for your exit, we can use the pivot point to help us define where the market might find potential selling pressure, right? And to help us define levels to take profit. Yeah. So it could be the R1, the R2, or the R3. Right? Does it make sense? Yeah. Can you see how all these different indicators have their own purpose? So for exits, we can use the pivot point to identify where the market may encounter potential selling pressure. So another example involves using the ATR and the Donchian channels, right? Which is what you have learned, right? So suppose you are looking for a low volatility breakout trade. So let's take a look at Brent crude, right? As an example. For a low volatility breakout, you would use what? The ATR indicator to identify volatility in the market. Yeah. You can then observe the current volatility is what? It's rather low, isn't it? So nearing multiple year lows. So in this scenario, the Donchian channel can now serve as a trigger for entering the trade. Alright, so when you notice that the price is breaking below or hitting the low of this blue line, it indicates that it has reached the 20-week low. So this signifies a low volatility breakout, as price has made a 20-week low in a low volatility breakout. So if you want to include additional indicators to trail your stop loss, you have options, right? So for example, if you recall, you can use the Chandler stop to trail your stop loss. You can also use a moving average to trail your stop loss. So for example, a 50-period moving average. So once you enter the trade, right, going short on the break, right, of these lows in the low volatility environment, you can use a 50-period moving average to trail your stop loss, right? So to manage your trade, you can then use the 50-period moving average and exit the trade only when the price closes above, right? Which occurs around this point, when the price closes above the 50 moving average, right? So you can see how combining indicators such as the moving average, the Donchian channel, the ATR can help formulate trading setups effectively, right? So I hope this explanation makes sense, right? And you can see this is an important aspect in trading. So let's do a quick recap, right? Number one, it is important to understand that different indicators serve different purposes. You must be clear about the purpose of each indicator that you use in your trading strategy. Yeah? Number two, it's important to know what you need from your indicators. Are you trying to identify the market conditions, looking to manage your trades, or identify areas of value, or something else? Right? When you understand your specific requirements, this will help you to select the most appropriate indicators. Right? Avoid using more than one indicator from each category. Right? Adding more can create unnecessary noise and clutter on your charts. Right? Additionally, right, limit the total number of indicators on your chart to 3 or fewer. Right? You got to maintain the clarity and focus on your trading signals. So if you are a price action trader who incorporates trading, right, incorporates indicators into your strategy, I would recommend using 1 or 2 of indicators at most, right? So this approach ensures that the indicators complement your price action analysis without overwhelming your trading strategy. So I've created a free 5-week training that shows you exactly how I trade. Check out the link in my bio.